studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that sunky died.
Once the expense review is complete, the next step is recording the results in the accounting records. Up to this point, you've identified which expenses are deductible, which are personal, and which require adjustments. Now those decisions must be reflected in the books through proper journal entries. This is one of the most important stages of the year-end process, because reviewing transactions alone does not change the financial statements. The books remain unchanged until the appropriate accounting entries are posted. The first journal entries record legitimate business expenses in their proper accounts. For example, allowable vehicle expenses, office expenses, professional fees, and eligible meal expenses remain as business expenses because they satisfy the tax rules and are supported by appropriate documentation. Recording these entries ensures that the corporation's financial statements accurately reflect the true cost of operating the business. The next step is removing personal and non-deductible expenses from the books. During the expense review, you may have identified items such as personal shopping, family expenses, personal travel, or unsupported purchases. These amounts should no longer remain in the corporation's expense accounts. Instead, they are typically reclassified to the shareholder loan account or another appropriate account, depending on the circumstances. This adjustment prevents personal spending from incorrectly reducing the corporation's taxable income. In many engagements, another important journal entry involves recording the owner's compensation. If the corporation decides to pay a salary, an accrual may be recorded at year-end by recognizing salary expense and creating a salary payable liability. This ensures that the corporation's financial statements properly reflect the compensation earned by the owner-manager during the year. As these journal entries are posted, the general ledger is automatically updated. Account balances change, shareholder loan balances are corrected, and the financial statements begin to reflect the true financial position of the corporation. Only after these updates are complete can the accountant confidently prepare the corporate tax return. Throughout this process, accuracy is essential. Every journal entry requires both a correct debit and a correct credit. Personal expenses must be removed from the appropriate accounts. Shareholder loan balances must be updated correctly. Supporting working papers should be retained, and every account balance should be reviewed to ensure the books remain balanced after all adjustments have been made. Think of the journal entries as the bridge between your analysis and the final financial statements. Without these entries, all of the review work you've completed would exist only on paper and would have no impact on the corporation's accounting records or tax returns. The key lesson from this slide is that professional accounting does not end with identifying problems. It ends by recording accurate journal entries that transform your analysis into reliable financial statements and tax-ready accounting records. After the accounting records have been cleaned up and all necessary journal entries have been posted, the accountant reaches one of the most important decisions in the entire engagement, determining how the owner-manager should receive compensation from the corporation. Unlike regular employees who simply receive a salary, owner-managers have several options. The corporation can pay a salary, declare dividends, reimburse legitimate business expenses, or use a combination of these methods. Choosing the right mix requires careful tax planning because each option has different tax consequences for both the corporation and the shareholder. Let's begin with salary. Paying a salary treats the owner as an employee of the corporation. Salary creates employment income that is reported on a T4 slip, requires payroll processing, and generally results in Canada Pension Plan contributions. An important advantage of salary is that it generates RRSP contribution room, which can provide valuable long-term tax planning opportunities. Salary also reduces the corporation's taxable income because it is generally deductible to the corporation. The second option is paying dividends. Dividends are distributions of the corporation's after-tax profits to its shareholders. Unlike salary, dividends do not require CPP contributions and do not create RRSP contribution room. Instead, they are reported on a T5 slip and are taxed under the dividend tax rules. For some owner-managers, dividends can provide a tax-efficient way to withdraw profits, depending on the corporation's circumstances and the shareholder's overall tax situation. A third option is reimbursing legitimate business expenses that the owner personally paid. If the owner used personal funds for eligible business expenses, such as vehicle costs, office supplies, or home office expenses, the corporation can reimburse those amounts without creating additional taxable income, provided the expenses are properly documented and genuinely relate to the business. These reimbursements also help reduce the shareholder loan balance without creating unnecessary tax consequences. So how do professionals decide which method to use? The decision depends on several important factors. They first review the shareholder loan balance to determine whether money has already been withdrawn from the corporation. Next, they consider the corporation's profitability and whether sufficient cash is available. They also evaluate the owner's personal tax situation, retirement planning goals, RRSP objectives, CPP considerations, and the overall tax impact on both the corporation and the individual. Rather than asking whether salary or dividends are better, experienced tax professionals ask a different question: what combination will produce the best overall result? In many situations, the answer is not choosing one method exclusively. Instead, a carefully planned combination of salary, dividends, and legitimate expense reimbursements provides the greatest flexibility while balancing tax efficiency, cash flow, retirement planning, and compliance with CRA rules. The key takeaway from this slide is simple. Owner-manager compensation is not a one-size-fits-all decision. It is a strategic planning exercise that considers the corporation's financial position, the shareholders' personal objectives, and the tax consequences of each available option. The best solution is rarely all salary or all dividends. It is usually the right combination of compensation methods tailored to the client's unique circumstances. This slide brings together everything we've covered so far and shows how the entire year-end accounting and tax planning process fits together. Every step builds on the previous one, and by following a structured workflow, the accountant transforms raw bookkeeping records into accurate financial statements and tax returns. The process begins with the expense review. Every transaction is analyzed, supporting documentation is verified, and each expense is classified as either deductible, requiring further information, or personal and non-deductible. This review provides the foundation for every adjustment that follows. Once the review is complete, the necessary journal entries are recorded. Legitimate business expenses remain in the books, while personal expenses are removed and reclassified where appropriate. These entries update the general ledger and ensure that the accounting records accurately reflect the corporation's financial activities. As part of these adjustments, the shareholder loan account is also updated. Personal expenses paid by the corporation and shareholder withdrawals are recorded correctly so that the balance accurately represents the amounts owed between the shareholder and the corporation. This step is especially important because the shareholder loan account often becomes one of the primary areas reviewed during tax planning. With accurate accounting records now in place, the accountant determines the owner's final compensation based on the corporation's profitability, available cash, shareholder loan balance, and the owner's personal tax objectives, the accountant decides on the most appropriate combination of salary, dividends, and legitimate expense reimbursements. This decision not only affects the corporation's tax position, but also influences the shareholder's personal tax return. After compensation has been finalized, the financial statements can be completed with confidence. Because the accounting records have already been reviewed and corrected, the financial statements now present an accurate picture of the corporation's income, expenses, assets, liabilities, and equity. These financial statements become the basis for preparing the corporate income tax return. At the same time, the owner's compensation decisions determine the information that will ultimately appear on the shareholder's personal tax return. Since both returns rely on the same accounting records, accuracy at every earlier stage is essential. When this process is completed correctly, everyone benefits. The corporation has clean accounting records, reliable financial statements, and accurate taxable income. The shareholder receives compensation in a tax-efficient manner while reducing the likelihood of unexpected tax liabilities. The tax professional maintains complete documentation, produces audit-ready working papers, and can confidently support every adjustment if questions arise later. Before finalizing the engagement, experienced accountants complete a final checklist. They verify account balances, confirm that all journal entries have been posted, prepare T4 or T5 slips when required, complete both the corporate and personal tax returns, and review the final results with the client. This final discussion helps the owner understand both the current year's tax outcome and future planning opportunities. The most important lesson from this section is that successful year-end work is never about a single calculation or one journal entry. It is a complete process in which bookkeeping, expense reviews, accounting adjustments, compensation planning, financial reporting, and tax preparation all work together. Accurate bookkeeping creates reliable financial statements, and thoughtful compensation planning creates tax-efficient outcomes. Together, they complete the year-end process and provide the client with both compliance and valuable tax planning advice.